Hello, I'm Nadine Blaney. In this week's edition of IG Macro Intelligence, we take a look at the Big Four Australian banks. The S&P ASX 200 financial sector is up 33% year to date, mostly driven by a rise in index leader CBA's share price. But many analysts say the stock and sector are overvalued. Shares in the Commonwealth Bank have risen almost 40% year to date and are up more than 50% over the past 12 months. That compares to a gain of around 11% on the S&P ASX 200 index, which has risen 18.5% over the past 12 months. CBA shares hit a record high of $160.27 last month and are trading on a price-to-earnings ratio of 27.94. Most analysts believe that CBA has run too far too fast, with the average price recommendation on the stock a sell. The average target price for CBA is $101.15. That's according to Refinitiv data, suggesting the stock should fall more than 35% from current levels. However, the technicals tell a different story. ASX TradeWatch data shows CBA is in a strong bullish trend, confirmed by multiple indicators. Yet, Morningstar banking analyst Nathan Zaya told AusBiz at these levels, it's a case of buyer beware.
CBA is very overvalued. I think it's trading around 70% above our valuation. And I mean, I guess a lot of people have tried to justify why it deserves to trade at such a premium, but I think looking at any sort of current trading multiples, current earnings forecasts, we just struggle to see how it can be, a PE of 25, dividend yield of 3. We just don't think it's very appealing.
Meanwhile, Nick Morton from Resident Asset Management Sorry, I breathed in and something went in my throat.
Should we redo from the top?
No, we'll just do it from here. Right? Because you've just come out of a package. Meanwhile, Nick Morton from Resident Asset Management is another one confused by CBA's rise and rise.
Yeah, the only way that CBA can really grow earnings from here, in our view, is through cost cutting, ultimately. And you've seen a lot of Matt Common's pronouncements around the use of AI and chatbots and things like that. So that's the approach they're trying to take to sort of defend their 25 times multiple, which is a huge amount for a cyclical business like a bank.
The CBA is hardly the only banking stock that has risen sharply in 2024, and Citi analysts are warning the sector could be in for a rough 2025. Analysts at Citi say valuations in the sector are overstretched and earnings growth is likely to be muted. They're warning ASX banking stocks could fall by as much as 30% next year. Martin Lakos from Macquarie, meanwhile, told AusBiz one reason the banking stocks keep being bid is the switch from institutions into the Big Four, despite their expensive valuations.
Certainly, the institutions look like that have actually been underweight the banks for a while, and quite a few of those institutions are shifting their investment models to a more passive, a greater index exposure, and being underweight one of the biggest sectors of the market, they would have to upweight, and so we're seeing money being allocated into the banks.
Despite some negative views on the overall banking sector, analysts do agree that some exposure to the Big Four is wise. John Story at UBS has upgraded Westpac to a buy rating from neutral, claiming it's the best of an expensive bunch. Expectations for the sector in 2025 are not much better, Story notes. However, he says the broader reputation of Aussie banks as predictable and stable remains in place. Westpac is currently trading on a PE of 17.36 and is trading on a dividend yield of 4.54%. Shares have risen 44% for Westpac so far in 2024, making them the best performer out of the Big Four. Meanwhile, Morningstar's Nathan Zaya picks ANZ as his preferred Big Four stock. ANZ shares are up about 21% year to date and 28% over the past year. Most analysts recommend holding the stock. Zaya says that investors are potentially overly cautious about its Suncorp banking acquisition.
People are worried about the integration with Suncorp Bank. They're doing a lot with their actual systems at the moment as well, so there's always risk there when you're integrating, cost overruns, just disrupting how customers interact with you. So I think those sorts of risks are maybe overpriced a little bit. So in a sector that's overvalued, I think that's probably the one that maybe the most.
Finally, when it comes to National Australia Bank shares, technicals show the stock can continue rallying in both the 20-day and 200-day moving average timeframes. Most analysts recommend holding the stock, which is up more than 27% year to date. And this is your IG Macro Intelligence for today. We'll see you next week.